Marcia Dawood, Chair of the Board of the Angel Capital Association USA. She is venture partner. She invested in over 200 early stage private companies, and she is a former founding member of the current chair of the Global Women's Capital Group Building Syndication. The topic we are hearing about now, an overview of where angel investing is right now with the state of global economy. Marcia, the stage is yours. Thank you.
Thank you so much. And thank you for having me. Welcome, everyone. So yes, the state of our economy and how it relates to angel investing. It's definitely been a roller coaster since this pandemic began. And actually what we saw in 2021 were some amazing highs. We had highest valuations that we've seen from companies, early stage companies, in a very long time. There was an incredible number of exits. The exit valuations were very high, and overall valuations were just off the charts. And just to give you a little bit of a perspective of this, according to PitchBook in 2021, seed deals, so that's the earliest stage of deals, cost investors twice what they cost in 2013. So 8 years later, the valuations have doubled. So it's just very crazy times. But now we are here in 2022, and we need to go back and look at in Q1 that we have had some significant downturns. And for example, IPOs were down 73%. SPACs have crashed. Goldman has now hit the pause button on many things. Valuations are falling. And some valuation multiples are down by 50%. Tiger Global, which is a big investment firm here in the US, has already started to renegotiate deals. And our SEC here in the US, our Securities and Exchange Commission, has started to warn that they are going to regulate cryptocurrency. So that is also falling. For those of you that follow cryptocurrency, you may have seen that in the early days of 2021, Bitcoin, probably the most popular of the cryptocurrencies, was up to $64,000 a Bitcoin. And as of this morning, it was struggling to stay above 20,000. So we have seen significant decreases. Exits are now coming down. In the US, exits for mergers and acquisitions are down 24%. And when exits slow, raising funds in venture and angel world gets a lot harder and takes a lot longer. So what does this really mean, and what were we seeing at the beginning of this year in Q1 of 2022? Well, if you look at the number of seed deals, the earliest stage deals, between the rounds that were done in Q4 of 2021, so at the end of the year, and then at the beginning of 2022 in Q1, we are seeing that seed rounds are down 41%. Series A is down 49%. And it goes like that through the B, the C, even up to Series H being down 51%. So we're seeing a slowdown on funding for early stage companies and even some of those later stage companies. The post-money valuations have started to decline, in many cases at the higher or the more mature companies. But for example, Series A, the valuations have decreased by 25%, but seed, they've only decreased by 5%. So what does this all mean? Well, it means for our portfolio companies, we really need to try to protect them. And in this type of an environment, cash is king. It's going to be very important that our portfolio companies preserve every bit of cash that they have, and that they take the steps to lower their burn rate and keep their revenues as high as possible. I know that sounds like an easy thing to do, but in a lot of cases, it is very tough. These companies are going to have a very hard time fundraising moving forward. It's not going to be nearly as easy as it was in 2021. So we encourage companies, if they are in the middle of a fundraise now, to continue that and to, if they can, oversubscribe the rounds that they have now so that they have the cash to kind of weather the storm. This isn't the first time that we've seen these things happen. Everything in life is cyclical, and we're just going through another cycle right now. But that doesn't mean that companies can't take advantage of the ability to fundraise where they can and be able to try to preserve the cash that they can now. And what does it mean for angels? Well, we need to be aware as angel investors of what we would call predatory capital. And that would be where other investors are trying to come in and maybe do a down round or cram downs, ways that the other investors will try to make it so that the angels just don't have as much of the company as they had in the past. And we want to make sure that we're looking at all of the ways that we can keep the valuations of our companies high. And really doing that is about hitting those milestones. So in some cases, companies, of course, are going to need to have cash, raise cash, but they're going to need the mentors, the advisors, the expertise that is needed in order to keep hitting the milestones and growing the companies. By playing defense, we can, reduce burn. We can also try to make extension rounds. So instead of trying to do a round that could result in a down round, we can do things like an extension of maybe a Series A or something like that. As a final note, I'll just say, look, it's not time to panic. I know things seem a little bleak right now with the way that our valuations seem to keep coming down, but it is really a great time to be an angel investor. This is more of a normalizing. And I think what will end up happening is we're going to find as angels that the deals are going to be more attractive for us to not only participate in, but to be able to be following on and doing things in order to help these companies grow. We bring more to the table than just money. We bring a lot of expertise and a lot of networking and social abilities to help these companies to really grow. And those are the things that will make the angels thrive in this type of economy. Thank you very much.